Hey, good evening. If you're out there, we're taking a look at the broader markets, and it's clear that the path of least resistance is lower. Of course, the question always is, well, lower to where? And we're going to take a look at some charts, and as you'll see, everything is going down everywhere around the world. So let's take a look at that. And just a second here. So here I have a weekly charts, actually daily charts. We're going to get to the weekly charts of ETFs, S&P 500 ETFs, as well as ETFs of different countries. You can see United Kingdom, France, Germany, Europe. Which, one of them is hedged, HEDI, Stock 50 ETF, Euro Stock 50 ETF, Japan, Taiwan. No matter where you look, the trend is down, and we look down to where. Well, today actually was a bit of a consolidation day. The momentum slowed down after there was this continuation pattern. How do we define a continuation pattern? So the prior 3 days, as you can see, I'm looking at the technology sector there. It was pretty much the same everywhere while we waited for the Fed announcement. It was just a consolidation sideways. And then during the day when the news came out, prices whipped up and down, and they took out the highs, which suggested, oh, here we go. It's going to go to the upside up towards some resistance. And then it made a vicious move to the downside and closed near the low of the day. And so that suggests, okay, now should go lower with a stop below the highs there. So no matter where you look, you put the stop above the highs. I'm just getting my little drawing thing out there. No matter where you look, you just put the stop above the highs, and it's the same everywhere. And concepts are universal. That's where the stop is going to be, or where there potentially would be some kind of a shock pattern where prices would reverse and get back above that high. That didn't happen today. Rather, it attempted to go higher, and it failed and just kind of got dead near the end of the day. I'm going to take a look at the intraday chart, so just stay with me for a little bit here. As you can see, no matter it was consumer staples, a defensive sector, healthcare, which turned around a little bit, you can see a green close there. Some of the stocks like Merck, Bristol Myers, Lilly, they showed some strength today. So some stabilization within the broader markets being weakly. And utilities held up a little bit. As you can see, Germany headed down and France headed down. Everything's going down. So let's take a look at weekly charts to expand the data. And you can see everything here suggests it's going down below the June, July lows. And there's many analysts out there that suggested, from a long-term perspective, the June, July lows were the low of this bear market move. Well, I wonder what they're thinking tonight, because I would not be one betting that that low is going to hold with patterns like this. Typically, what happens is prices break down below those lows and create a tremendous amount of doubt, and then things begin to stabilize. One of the things I covered in the weekend advisory letter was, even going a couple of weeks ago, was that this green reversal bar within the existing market had a high probability of failing and creating a measured move lower. And that certainly looks like it's going to follow through. So the measured move lower is where you get this move that pulls back. It tries to attempt to go up, and then you get a measured move to the downside, which typically goes down to an area of prior support. And then as it takes out that low, the concept of a greater than 100% retracement will begin to play in, and then we'll see what kind of counter trend move will happen from there. And we've got this pattern across the board to varying degrees, and what has been weaker, like technology, is closer to taking out those lows to other sectors which have been stronger. Now, one of the strongest have been energy, and we can see now that's beginning to give it up, and that looks like it's going to head lower. And all of that makes sense from the point of view of the recession that the markets or the economy is in, regardless of what these politicians are saying or these talking heads are saying, where even based on their own historical reference of two negative GDPs being a recession, now they want to hedge that. Look, it's ridiculous. We all know the inflation being at 40-year highs, um, everything being as negative as it is, the economy's in recession, and it's likely to get worse as we look at interest rates going higher, which we can take a look at here. Let me switch to a different page. Let's go to this big picture scenario, and let's look at the 10-year note, which closed up above 3.7%. Now, it's a wide range bar. Wide range bars typically signal the end of a move. Well, to some degree, let's say, where momentum typically stalls. So the wide range bar is an emotional bar that depicts that, and the naysayers giving it in. Down below here is high yield corporate bonds, and it has a good inverse relationship, as you can see, where at this point, risk is being put on by institutions, risk off. It's down near the prior lows. It's taking out those lows. We've got a wide range bar. I think if tomorrow has a bit of a capitulation to the downside near those June, July lows, we're going to see a tradable low bounce beginning to take hold at that point. And you can look across the board here. Bitcoin showed some stabilization. It's down here on the edge of the abyss, so to speak, because there's a void below. And whether it's energy, you can see the S&Ps need to come down here near these lows. They're getting close. Right, so we've got these pivot lows right there, and then the June, July lows down below. So somewhere down here, if they can reach those levels tomorrow, I'm looking for things to stabilize, and that may happen later in the morning or in the afternoon. We'll see how it goes down. The dollar is still going up. Emerging markets are going down, and I keep track of this because when the dollar at some point does begin to top out and pull back, emerging markets will move up. That'll be another bullish sign. We'll see these corporate bonds, high yield corporate bonds, begin to move up. So these are excellent guides as to turning points in the market that we'll be keeping an eye on. Now, what happened today? Well, it was basically markets came down to levels where they stabilized, and they did make a short-term attempt to move up, and they cleared these pivot highs. That's what this PH is. They cleared these pivot highs with good NYSE tick reaching some extremes. And then when they bought the pullback, it looked like it was going to go higher, and it just failed. It couldn't get up to this 3,800. Our credit spreads on SPX never got touched. They were full profitable to the upside or the downside. I cover those every morning in our pre-market review, which you can log into YouTube, youtube.com/C/Master Trader. I do that every morning. Dan goes over gappers and our open trades, and we review our bias, what's going to happen for the next day, and provide those SPX levels. Now, as you can see, the AD line, it come down to a very negative level and just stabilized. It never really got near positive at all. Even though it stabilized there, it was kind of like dead in the water down there. The VIX, was declining, and that popped back up, of course, as it did. And looking here, we're just looking for prices to come down into these levels here, ideally tomorrow. It was, from an hourly time frame point of view, it was pretty much just an uneventful day where prices consolidated, which leaves this what we call an end of day base. And so with the reversal at the end of the day, right, it tried to move up and back down. That suggests it would go lower. Now, if we can clear these highs, the idea of coming down here might be off the table, but we'll just have to see how that plays out. Right now, everything, as I showed you, is negative across the world. From a daily chart perspective, this AD line just stays under the zero line, which is bearish, coming down toward minus 2,000 and staying down there during the day is bearish. Markets cannot bounce. In other words, even speculators are just not confident. It's just scalpers, and any sign of weakness, people just hit the bid. And ideally, this will just follow through to the downside where things begin to take hold over a period of days, and we get a tradable bounce as we come into the end of the month. And then we'll see what October brings. So we'll see how this plays out. We'll be on in the morning at 9 o'clock reviewing what happened overnight, whether you're on Twitter, on YouTube, on Facebook. We'll be on there across the board there. So log in, check it out. If you have any questions, email myself, Greg at Master Trader, and of course, Dan at Master Trader, especially if you have options questions related to credit spreads and any option strategies. Best to email Dan. He's the expert on all of that. But stay tuned. Ideally, this market is headed toward those June, July lows where there'll be some capitulation, ideally taking it out, maybe hitting 3,600. And I'd really like to see that. We're looking at, let me just flip this to a weekly chart where I talked about this measured move going to the downside. And you can see kind of this same scenario is playing out on the daily time frame where you've got this move down, the stabilization, it took out the highs, and now this being a measured move, right, on this time frame and this particular segment of the time frame. And what we do here, just to show you where this move continues about an equal distance of that move, which will put it somewhere right around here. That's typically how it plays out. So ideally, this will flow to the downside tomorrow into the end of the week, which will set up trading opportunity for a bounce next week. So stay tuned. We'll talk soon.